Good morning. I'd like to welcome all of you to our succession planning webinar, jointly hosted today by Johnson Financial Group and Husch Blackwell. My name is Jackie Ruppel, and I am the Vice President of Private Banking and Milwaukee Regional Manager for Johnson Financial Group. I'm pleased to be moderating our program today and so glad that you've joined us. Before we begin, I'd like to cover a few housekeeping items. At the beginning here, on the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, I will be monitoring those throughout the program. Please submit those via the question box. We will try to answer all of your questions during the webcast today, but if a fuller answer is needed or if we run out of time, it will be answered later via email. A PDF of the presentation is available in the resources folder, along with links to Husch Blackwell and Johnson Financial Group's information and social media. This program has been approved for your legal education hours. To report your hours, please click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and for sharing. Toward the end of the program, please be sure to complete our brief survey. We use your feedback to plan future programs that are applicable to your business needs. That's it for housekeeping, so let's get started on our program. As we stated in our invitation, succession planning is not easy in today's world of unknowns, but getting it right is critical to ensure the future success of your business. Today, we are going to discuss strategies to determine and maximize the valuation of your business, important steps when preparing your business for sale or transition, structuring a transition that incentivizes key employees while shifting control to new owners, and examining how proper planning can minimize those tax liabilities. Let's get to our speakers. Joining me today are Rhett Holland and Philip Miller, partners with Husch Blackwell, and Joe Meyer, SVP, Director of Wealth Strategy with Johnson Financial Group. Rhett represents clients in a full spectrum of estate and business succession planning matters, ensuring that they and their families are protected for the long term. For Phil, estate and business succession planning is more than a job. It's a passion that he pursues while employing his strong tax and accounting background to clients' benefit. Joe helps you achieve your wealth and legacy planning goals and has a breadth of experience serving family businesses with a deep understanding of wealth transfer strategies. With such a great panel of speakers today, let's get started with Joe and the 3 key secrets to succession planning.
How we all doing? So what I want to talk about today, and the reason I call my portion of the presentation the 3 secrets of succession planning, that in the hundreds of succession plans that I've done, these are the things that are sort of critically important. They drive the entire plan. They drive the entire success of the plan. When the plan fails, they drive the failure of the plan. And I was just out on Google this weekend and tested this again. They're the things that no one writes about. They're the things that nobody talks about. So think about those 2 things together. They're, again, in my experience, the most important part of the succession plan, and they're the things that nobody ever speaks about. And the first is, and you can see the poll question up here when we sort of give away what the first secret is around happiness. It's what is the purpose of a succession plan? Stated another way, why do we engage in succession planning? And again, I went out and looked at a lot of different articles and blog posts and videos and vlogs around succession planning, and I came up with a lot of different words. And basically, what most people say succession planning is, they use the word complex, they use the words tax minimization, they use the word strategy, and they use the words leadership. So it's this complex strategy of transitioning leadership in a tax minimized way. And that's not inaccurate, but it also is unresponsive. The best description I saw out on the web when I went and looked this morning was by a group called the Exit Planning Institute that said exit planning, that was the term they used. Exit planning was a strategy to maximize the value of your business and transition it to the people who should run it. That's closer, in my opinion, to the truth, but it's not quite there. Here, in my experiences, is the why behind succession planning. It is, like any financial strategy, a strategy to utilize your income and assets to maximize your happiness by taking care of the people that you care about. Let me repeat that because I think it's critically important. It is a strategy wherein you utilize your assets and income to maximize your happiness to take care of the people you care about. And so again, it is a happiness, not a value maximization process. And the reason I share that with you is I can tell you probably 40 to 50% of the succession plans that I've worked with business owners on that have been successful succession plans that have made the business owner and the business owner family very happy, very fulfilled, very excited. It was a success. If we look back at what the plan was and how we did it, we didn't maximize the value of the company. We would have maximized the value of the company by doing something different, maybe selling it to a private equity company or selling it to a strategic buyer. But we maximized the happiness and fulfillment of the business owner. And that gets down to the second secret of succession planning, which is, what is the purpose of the plan? Because let's face it, succession planning is a recognition. It's a recognition of mortality. Stated another way, it is simply true that the ownership and leadership of a company will eventually transition to someone else. And so when we talk about succession planning purpose, we start with that reality. Someone else is eventually going to run your company. Someone else is eventually going to own your company. The question is, what, again, around that sort of framework of happiness, as you think about who that new owner or owners is or are going to be, as you think of who those new leaders are going to be, what makes you happy? Do you want a situation where those owners and leaders are family members, in which case your purpose really centers on what we call legacy? Do you view your business as a legacy asset, something that you want the ownership of, want the leadership of, to transition down to the next generation and to be a multi-generational legacy asset? Maybe you purchased the business from your parents. Maybe the business was started by your grandparents, and that multi-generational aspect is critically important. Jackie and I work for a multi-generational company. We are owned by a multi-generational family. We are owned by a family that owns a company, SC Johnson, that is currently in its 7th generation of ownership. The succession purpose of the Johnson family is one of legacy. Now, that might not be your purpose. Your purpose could be loyalty. And that is really about the primary purpose in the transition of ownership and leadership really being about being loyal to those people that helped get you there. That might mean that certainly means that we need that succession process to take care of those internal leaders, those people that you owe a sense of loyalty to. So we got to make sure that the succession process accomplishes that purpose. But it also might mean that when it comes to how we're going to structure the transition of leadership and ownership, that we focus on transitioning both of those things to your current management team, to people who currently work with you, maybe to your employees in some sort of ESOP structure. So again, for people who say that their primary succession purpose is around loyalty, around the protection and value maximization and happiness maximization of those people that help get them there, loyalty becomes that succession planning purpose, and we design the plan around that. And finally, there's a lot of people who look at their business the way they look at any investment, the way they look at their stock portfolio or their bond portfolio. It's just a mechanism to make money and maximize wealth. And for those people, their primary succession purpose is one of liquidity, like any investment. They want to sell that investment at a point in time and for a price that maximizes their net worth. So again, taking a step back, it is critical, and I don't see this nearly spoken about enough in sort of succession planning blogs or exit planning blogs or articles, that really the place that you need to start is what makes the business owner happy. What is that succession purpose? Is it a primary purpose of legacy? Let's keep the business in the family. Let's make it a family-owned business. Let's make the DNA the core of being part of that family, being involved in and owning that business. That's one potential purpose, which creates the planning architecture that Phil and Rhett are going to talk about more and how we do that. One potential purpose is loyalty. How do we make sure that we protect those internal management people, those employees, those customers that helped us get where we want to go? And again, that creates some structural or architecture priorities within that purpose. And then finally, the third potential purpose is liquidity. Let's just sell the business for as much as possible. And again, Rhett and Phil are going to go into within each of those purposes, right? Once we define the purposes, what does the architecture look like, and how do we maximize the success of how to execute on that purpose? The third thing I want to talk about is the power of irrelevancy. And that's sort of interesting to hear that phraseology, right? Because power is a positive adjective. And most people think irrelevancy is sort of a negative adjective, right? We don't want to be thought of as irrelevant. But here's the thing maybe the most important thing I'm going to talk about in my 15 minutes today. I want to share this with all the business owners. You want to be irrelevant. You want to continue to develop a plan to make yourself irrelevant. And here's why. A couple of examples. The first example I want you to think about is we got to go back in time. We got to, get in that DeLorean, go back in time to the Middle Ages. And I want you to think about Michelangelo. And I want you to think about a business called Michelangelo Sculpture Studio. And then I want you to think about what you would pay for Michelangelo Sculpture Studio. And as you think about that, the answer it should come relatively clear, relatively quick, that the answer is it depends. It depends on whether Michelangelo is going to work for me, and it depends on what I have to pay him. Because if I'm going to buy Michelangelo Sculpture Studio without Michelangelo, it's worthless. For those of you who watch the television show Succession on HBO, in the first season, they dealt with this problem of lack of irrelevancy pretty acutely when the protagonist, Logan Roy, was very sick in the first season of the show, and the board was meeting and talking about what's going to happen to stock price. And literally, there was a deep concern that as Logan Roy's illness, as his sickness was becoming more public, the stock price was going to go in the tank. For a more real life example than talking about middle-aged sculptors or an HBO show, I did a presentation to a small group of business owners, what I think used to be called a tech group. I think it's called a Visage group now. And one of the business owners, as we were talking about this power of irrelevancy topic, started talking about a real life example that happened with him, where he had positioned his business very well for a third party purchase. And then during the due diligence period got sick and was in the hospital, and the buyer dropped the price in half. Simply because of the fact that this person, this business owner, was incredibly important to the business, was important to the value of the business. And without that owner there, the business's value to the buyer was literally cut in half. Here's the equation, folks, the one, again, that we probably is counterintuitive, but it's really important to remember. The more valuable you are to your company, the less valuable your company is to you. So when you think about succession and readying your business for succession, whether it's legacy, handing it off to family members, whether it's loyalty, selling it, transitioning it to insiders who have worked with you, or whether it's liquidity, selling it to an outsider, regardless of the structure, the more important you are to your business, the more critical you are to your business, the less valuable your business is to you. And the question I always ask business owners as we're talking about succession and leading off a succession process, and you saw it in the poll, how long could you go sailing in the Virgin Islands without access to Wi-Fi or internet, without your business suffering economically? If the answer to that is, I couldn't leave, we've got issues, right? You are way too important to your business, and therefore the value your business has to you is way too small for what the value of the business should be. If it's, I could leave for 6 months and my business would be just fine, you have a business that is ready for succession because you've made yourself irrelevant. So again, at the end of this, as we sort of set the stage, remember 3 things. Number 1, how do we engage in a process to maximize your happiness? Number 2, what is your succession purpose? Is it legacy, family? Is it loyalty, insiders? Is it liquidity, maximize price? And finally, the power of irrelevance. The less valuable you are to your business, the more valuable your business is to you. All right, I'll hand it back to Jackie. Thank you.
Great. Thank you so much, Joe. Now that you know all of the 3 key secrets to succession planning, I'm going to hand it over to Phil Miller to discuss how timing is so important when it comes to business succession planning.
Thank you, Jackie. Well, as they say in real estate, it's all about location, location, location. When it comes to succession planning, I think it's timing, timing, timing. Timing is everything. Timing is, when you think about all the things Joe just talked about, having the time to evaluate the things he talked about, what's important to the owner, who are likely buyers, and then to implement a plan that is put together, that all takes time. In the all too typical scenario, we run into business owners who retain ownership and control beyond when they probably should have. And control, I think, is really a key part of it. It's always interesting to me when I run into or talk to people that were in management and left a company after a number of years because they had been in the wings to eventually buy or take over and run the business, and it never happened. It really stuns me when I talk to children of an owner that were in the business and left because they, they didn't know what the game plan was. They didn't know when or if they were going to either have control, operate it, or have the pride of ownership. in the worst case scenario, if the owner is in his 90s and the children are in their 60s and thinking about retiring themselves, that's not a good time to first start talking about succession planning. I think it's important to look at why owners hang on as long as they do, and to ask them when they've thought about retiring or starting to turn over ownership and then ultimately control. Is it because the owner still enjoys running a business? Go back to Joe's question, what makes them happy? Is it because they have no outside interest to occupy their time in retirement? Some people, I've talked to owners who say, the business is my hobby. It's what I enjoy. It's what makes me happy getting up every morning, getting up and going to work. Sometimes it's pride of ownership. It's always interesting to talk to owners who will comment on the awesome responsibility when they think about the number of people they employ and the lives they touch, the livings that they afford their employees and their families. There's quite a bit of pride in that. And sometimes it's an emotional attachment, the owner who just can't let go. But whether it is key employees or whether it's children waiting in the wings, holding on too long is going to be problematic. Reasons we should focus on timing include avoiding a sale in a bad economy. I would ask everybody viewing our presentation, think about where you were 1 year ago today, where your business was economically, and how that's changed since, February, mid-March, when all of a sudden we're facing a worldwide pandemic and stay-at-home orders, especially if you have a business that was deemed non-essential. Things change in a heartbeat. You want to avoid a fire sale, a low sale because you need to raise cash fast. Of course, that's typically the scenario we're looking at if an owner dies without having transitioned the business. The estate tax is due 9 months after date of death. And there's very few exceptions or extensions available. Otherwise, you're going to pay interest on the tax that should have been paid and wasn't. So we do want to avoid a situation where people have to sell quick because they need money. Again, avoid losing key employees or future owners, and that can even include children. It's always amazing when children were in the business and left because they didn't know what the overall game plan was. Competitive factors that might affect a sale. When you're looking at what the succession plan is, are you keeping up with changes in technology? Are you looking at other competitive factors, whether your competitors are being bought up? If competitors are being bought up and you're not the one doing the buying, that may be an indicator of trouble down the road. And then we have to think about the timeline needed to accomplish all the things that have to happen before a succession plan is implemented. Training and grooming the next generation. It's not just, you've hung around since you were a kid in high school sweeping floors. It's knowing the ins and outs of all the different parts, production, sales, different management functions, who does what. If you do have the person who's been around since high school sweeping floors, typically there's going to be a transition in onboarding, because now that person who a lot of longtime employees watched grow up is eventually going to become their boss, and you have to deal with that. I'll add that some of the best succession plans I've ever seen were scenarios, whether by chance or by company policy, the future owners could not come on board and be considered for succession until they had spent a number of years in the outside world, basically seeing what the rest of the world is like. And, in a number of those cases, I've seen where they set a minimum of 2. I know of cases where it was at least 5. You have to factor that time in too. You don't want to take the kids just out of college and assume that they can become a vice president. In other cases, it's going to be, I'm going to ask my co-presenters to mute your mics, please. Sometimes it's hitting a target value. Joe spoke about this briefly. You have a target value in mind, but then you have to look critically at what you're doing and say, how long is it going to take me to get there? And if it's going to take me this long to get there under ideal circumstances, what happens if I hit potholes along the way, a bad economy, those competitive factors, or, whether it was tariffs or the pandemic or whatever. And then it's time to actually put a buyout in place. Typically with a management buyout, you're starting off looking at incentives to get people to stay on, and you're giving them a timeline as to what you're looking at so that they know what the game plan is. You don't want the people you're selling to be starting to think about their retirement and wondering why they still don't have any ownership. Sometimes we need to look backward and think about what it is. What's our target date? Couple of succession plans I've worked on, we actually did a timeline. We created a timeline, I think it was in Microsoft Visio, and we put waypoints along the way. We put the owners' birthdays and ages in 5-year increments, and we put other things that were happening with the family. And then we came up with a target date on when transition to the next generation would happen. And every time we met, we pulled up and updated that. The nice thing about that timeline was there was a red dot on the timeline that said today. So every time we met and pulled that up, it would show us, okay, here's where we are today. How much did we accomplish since the last time we met? And what are we looking at toward the future? Very helpful in terms of staying on task and staying focused on what we needed to accomplish to get to the ultimate succession. And for anybody who are, visual learners or visual is best, it was just very handy. I've got a couple of case studies just to highlight some points of why timing is so important. In the first one, I've got two co-owners, Al and Ben, equal owners, about the same age. They've been friends for life. They've run this business for decades. They have a buy-sell in place, but in the long run, both envision retiring at the same time and selling to an outside party. So sure, they have a buy-sell. They know that one might have to buy the other out. They talk every 2 years. They sit down and they review the valuation and the terms of the agreement. But in their minds, yeah, this isn't likely how it's going to go. You really need to think about that, though. Consider the timing. Have they agreed on what the retirement date is? If one is thinking, I'm going to retire at 60 and the other's going to retire at 70, then even though they have a buy-sell in place, they really haven't fully thought through the execution of their succession plan. So it's not just, well, we'll retire together and sell together, and that should happen at the same time because they're the same age. In my example, Ben wasn't ready to retire when Al was. Ben wanted to retire, or Al wanted to retire earlier and pursue some outside interests, spend more time with the grandkids. Ben was still having a lot of fun running the business and actually kind of wanted to buy time until the next generation came along, because the next generation ultimately did have an interest in the business. So that buy-sell agreement that they didn't think they would need ultimately was used to accomplish the buyout of one from the other. Again, target date. If there's one thing I would say about timing, two things actually. First of all, you need to focus on it. The second most important thing is you need to be flexible. And the second case study really highlights that. owner has set a date, age 65. I'm going to retire at 65. I'm going to sell to an outside buyer when that time comes, and that's just the way it's going to be. And in a perfect world, I wish I had statistics that told me how often that actually happens, how often all the stars align so that when somebody says that, it actually happens the way they envisioned it. If you, for example, in case study number 2, strong economy and a peak time in the life cycle of the business create conditions where, granted this is in hindsight, a sale 7 years before that target date that's in the owner's mind would have brought a maximum value. Owner sticks to the original plan, reaches the target date. Now the economy is not so strong, and in the intervening 7 years, new technology has come along, which has decreased future demand for the business's product line. Now the owner certainly can still retire, sell the business, but is looking at a devalued business. And so if the goal is, now, go back to Joe's comment, what's important to the owner? What makes the owner happy? If that 7 years of running the business were good years for the owner and the amount of devaluation is not so great, maybe it's not so bad. But if you have an owner who is regretting, gee, I should have sold sooner, I shouldn't have let this go so long, then flexibility would have been very helpful. One last comment. What do you do for the person who has no successors, no succession plan? It occurred to me years ago, I was running into more and more young business owners, very young kids, very successful business owners, be it startups or more established businesses. Kids are too young to know for decades whether or not that they'll be part of the succession. And it was hard to identify outside buyers. So what do you do? Do you just not worry about it? Do you just kind of put it aside and think, well, we'll talk about that in 5 or 10 years? You can't really do that, because when you talk about maximizing value, really in those cases, I think it's about preserving value. If the unexpected happened, an untimely illness or death, you want to preserve value. You want to try to keep the doors open and maximize as much value of that business rather than just close doors, watch employees walk away, and end up liquidating and getting what you can. There are things we can do. There's some planning that we can do to say we can maximize value and at least make a good attempt at preserving value. So in closing, what estate planning or business succession planning is it's not something that can be put off until retirement. And it's not something that's done once and put on a shelf. It really is an ongoing process. It's something that is always changing and adapting to the changes in circumstances and outside factors. So I think it helps to have an advisor who knows the business, knows the owner, is cognizant of those changes, and then to discuss it frequently, not just think, well, okay, let's review it every 5 or 10 years. So with that, I'm going to turn it over to Jackie, and we'll move on. Thank you.
Great. Thank you so much, Phil. Wow, timing really is everything. Thank you for sharing each of those scenarios. I'm sure that our audience can certainly relate to at least one of those. Before we move on to our last speaker today, just a reminder to submit questions via the question box, and we'll be happy to address those. I think that we can all agree that 2020 has been quite the year so far. Rhett Holland is going to be discussing some key planning points for succession planning in 2020 and beyond. Take it away, Rhett.
Great. Thanks, Jackie. Hello, everyone. So Phil and Joe both spent time talking about the long-term considerations for business succession planning. And those are the considerations and the plan that you put in place in the event your exit from the company occurs on your own timeline and on your own terms. What I wanted to talk about today, though, is the interplay between succession planning and estate planning. So we have our long-term plan, but we also have to have our short-term plan that runs alongside. And the short-term plan addresses what happens in the event something happens that's outside of your control. Let's say someone were to pass prematurely. What happens then to the company? And especially in this case in 2020, what happens if something else out of your control, like the tax laws, change? So what steps can we take today to reduce potential estate tax exposure? What are the short-term actions that you can take to protect the value of the business and the value that may be transitioned to your family, even though you may not have made all of those long-term decisions about purpose and about the timeline for the actual transition? What steps can we take from an estate tax and estate planning perspective without negatively impacting your financial security, without negatively impacting your ability to implement your long-term plan, and without negatively impacting your ability to control your company? Before we jump into the actual specifics, let's talk a little bit about the transfer tax system. So here in the United States, we do have a 40% transfer tax. During your lifetime, that's a gift tax. Upon your death, that's an estate tax. Under the current laws, each individual has an $11.58 million exemption, though. That's the amount that you can give away before this 40% tax starts to apply. So a married couple has over $23 million that they can give away during their lifetime or at death without having to worry about paying this 40% tax. Under the current laws, there's a lot of the estate tax only applies to very few people, a small percentage of the population. The problem is that the tax laws are set to change. We have just over 5 years of these high exemption amounts under the current law. And the current law is only as permanent as the current Congress. So on January 1st of 2026, that estate tax exemption amount is going to drop by 50%. And we have an election in November. I think it's pretty clear that if Joe Biden and the Democrats retake control of the federal government, the tax laws are going to change. And they're going to change in a way that's not favorable to high income earners and wealthy individuals and families. What does that mean? This slide is intended to illustrate what the potential impact would be of a change to the estate tax laws. So under the current law, we have a married couple with a net worth of $20 million. They have a $23 million exemption amount, which means that they can transfer all of their wealth to their family without paying any estate taxes. Now let's transition over to what the law could be next year. We anticipate that the exemption amounts would drop substantially if the Democrats retake control of the federal government. And that exemption amount, instead of being $23 million for a married couple, would likely drop to somewhere in the range of $7 million. That means that the same $20 million estate, that couple could pass $7 million free of estate taxes, and the remaining $13 million would be subject to tax at that 40% rate. That means that the same married couple on December 31st of 2020 would pay no estate taxes, and if they both pass away in 2021, their family would owe $5.2 million of estate taxes. And as Phil mentioned, that's a tax that has to be paid in cash within 9 months of the date of the surviving spouse's passing. So what I want to do is talk about what steps you can take to try to eliminate or reduce that potential estate tax liability if the laws change. So where does this fall in the estate planning process? We like to think of estate planning as a 4-step process. Step 1 is getting your core documents in place. That's your revocable trust, wills, powers of attorney, and advance directives. For wealthy individuals, we have to move forward to the other steps. The next step is, how can we depress the value of those assets to reduce that potential estate tax liability? Remember, the estate tax is imposed against the value of your estate. So if we can reduce the value of the assets, that's going to be helpful. We reduce the value of the assets, and then step 3, we transfer those assets out to your family at those lower amounts. If you reach the point where you feel like you've given enough to your family, that final stage would be charitable planning. So what I want to focus on with the rest of my time today is, what are the steps that you can take to discount the value of your estate, and then where do those assets go? So again, the estate tax is imposed against the value of everything that you own. Now, if your estate is comprised of publicly held securities like IBM, it's very easy to determine that value. There's a closing price every day. If, on the other hand, your estate is comprised of closely held business interests, it's very difficult to determine what the value of those interests are on any given day. And so where we come in is we try to look for ways to argue that what you own is actually worth less on paper. And now, how do we do that? There's a few key techniques. The first is to fractionalize ownership. This is what we think of as minority discounting. So let's say I own a company that's worth $1 million, and I offer to sell you a 40% stake in my company for $400,000. Would you buy it? The answer is probably no. You probably wouldn't buy that 40% interest for $400,000, and why is that? The first reason is, you're buying an interest in a closely held company. It's not a marketable asset. If you decide you want to sell, you could be very limited in the number of people that would want to buy it. The second is, you are a minority owner. You only own 40%. You have no say in how that company is operated. You're stuck with me as the 60% owner. And so because of that, because you have no control and it's not a marketable asset, we can bring the value down for transfer tax purposes. The second way is to create voting and non-voting stock. It's the same thought process. If someone tries to transfer or sell you non-voting stock, you probably wouldn't pay the equivalent of that percentage ownership of the company because you have no voting control. You're stuck at the whim of the voting owners. And then finally would be the creation of family limited partnerships, or LLCs. So if you don't have an operating business, maybe we can create one for you so that we can then take advantage of these same discounting techniques to bring the value of those assets down from a transfer tax perspective. Now, the preferred process that I have would be to recapitalize companies so that we create voting and non-voting interests. That allows us to take those discounts off of the non-voting interests, and then you can transfer those interests out of your estate at that lower value so we can take advantage of the exemption that you have and hopefully reduce that tax liability in the future. So we have a lot of clients who are ready to plan to reduce the tax liability. The problem that we run into and the sort of balancing act that clients have to deal with is, I want to reduce the tax liability, but hey, I may need these assets, especially if we're talking about someone with that $20 million net worth. They can't just give away everything. So what can we do to reduce that tax liability and continue to retain flexibility so the clients can access the assets? That's where the irrevocable trust structure comes into play. So if you think of an irrevocable trust, it's an entity that you would create. You name a trustee. The trustee is in charge of managing those assets and making distributions out to your designated beneficiaries. When you make a contribution into that trust or a gift, it counts against your lifetime exemption amount, and the assets in that trust are no longer available or no longer part of your estate for estate tax purposes. The assets in the trust are also protected in the event one of your beneficiaries is subject to a creditor claim, or potentially if one of them gets a divorce. Now, again, why do we create a trust to receive these interests? The first is that the assets you transfer to the trust and the appreciation on those assets are not part of your estate for estate tax purposes. But here's the kicker. You can name your spouse as the beneficiary and trustee of the trust that you create. So I create a trust for my wife. I make a gift of my stock in my company to that trust. That uses some of my lifetime exemption, and that stock is no longer in my estate. My spouse, though, my wife, if she ever needs to, can pull assets back out of that trust. So you're not negatively impacting your family's financial security by engaging in planning to reduce the estate taxes. Same thing holds true for my wife. She could create a trust for me. So I create a trust for my wife and transfer stock into it. She does the same for me. If you Google, unlike what Joe said, where he looked and the topics he discussed were not online, if you Google slats, you'll see a lot of materials on this. And that's because this type of planning does allow for flexibility for the family. So why don't we take a look at how this would actually look in the real world? So husband, we recapitalize the company. We create voting and non-voting units. Husband and wife keep the voting units or voting shares, so they retain control of the company. They transfer out the non-voting units into trusts. So husband transfers non-voting units into a trust for his wife. Wife transfers non-voting interests or shares into a trust for husband. So we've moved assets out of the estate for tax purposes. We've retained control over those assets, and we have not negatively impacted the family's ability to implement their long-term succession plan. Now, how does this look from an actual cash flow perspective? So we have our family business on the right-hand side here. Family business is what's generating all of the income. Husband and wife still own the Class A voting shares, so they decide when it's appropriate to make distributions to the shareholders. These trusts are now shareholders in our company. So husband and wife decide to make a distribution out to the shareholders. That wealth stays in the trusts and outside of our clients' estates for estate tax purposes. However, if wife decides she needs some funds from the trust, she can take a distribution. And if husband decides he needs some funds from the trust, he can take a distribution. So again, at the end of the day, clients, husband and wife, still have the ability to access the wealth that they've created. They still have the ability to implement their long-term succession plan for the company. They've reduced estate taxes, and they've, for now, retained control because they're the Class A shareholders. So with the few minutes that I have left, I think what I'd like to do is just touch briefly on what our clients are actually doing. The first thing is clients are planning. They're planning with urgency. I think for most wealthy individuals, people understand that these high exemption amounts are not here to stay. At best, those higher exemption amounts will be here for another 5 years. At worst, those higher exemption amounts will be here for another 3 months. So what are they doing? Clients are using these high exemption amounts as an opportunity. They're transferring assets to irrevocable trusts like the ones that we discussed a minute ago. Those could be the his and her trusts or slats where husband creates for wife, wife creates for husband, or if husband and wife are comfortable and do not think that they'll need to access those assets in the future, they could just place the assets into trusts for their children. A lot of clients like the idea of leaving assets in trust for their children because assets that you leave in an irrevocable trust for the benefit of your kids will be protected if one of your children is sued in the future. Assets that you leave in an irrevocable trust for your children will be protected if one of your children gets a divorce in the future. Divorce is obviously a hot button topic. It's one that we discuss in almost every estate planning meeting. What else are people doing with these high exemption amounts? You may have made loans to your kids in the past or family members. Use this higher exemption amount to forgive the balance of those loans. If you forgive the balance of an outstanding loan to a family member that uses some of your exemption, that exemption could be gone next year anyway. The next step would be if you have a life insurance trust. A lot of business owners in the past created life insurance trusts to hold life insurance policies intended to pay estate taxes. But each year you have to make a contribution to that trust to pay the life insurance premiums. Let's just go ahead and use some of that higher exemption amount, prepay a lot of those premiums on the life insurance, and simplify the administration of the trust and the estate plan. Finally, opportunity shifting. This is kind of one of the exciting parts. If you create an irrevocable trust and you transfer wealth to that trust, the trust could be the vehicle to invest in new ventures and new opportunities, because all of the wealth that you generate in that trust is going to eventually pass to your family without paying any estate taxes. Final point, this goes to what Phil was talking about with children who may not know the succession plan and children who leave the family business because they don't know. Clients are having family meetings. They're talking to their kids about the succession plan, the plan for the company. They're talking to their kids about the estate plan. They're talking to their kids about the role that the company plays in the family's life, and they're talking to their kids about the role that inherited wealth should play in the family's life. So that's about all I have prepared for today. Maybe, Jackie, we can open it up for questions.
Great. Thank you so much, Rhett. I do have a couple of questions from the audience. I'm going to share the first one. The first question is, what should you be doing in the current time when your business value is down and the expense to continue may be larger than the sale value? As an example, I am a business owner where office rental is the primary income and maintenance of property is the main expense.
I'll
Rhett,
tackle that one.
That question? Or, oh, go ahead.
I'll tackle that one first, and Joe and Rhett, feel free to chime in.
Great.
Tough question. You know, we've been hearing so much about what's going on with real estate. Are people going to return to offices? I think fortunately for the person who asked the question, there are already stories coming out where as well as technology has enabled us to work from home, there are aspects of it that that don't make it viable in the long run. And so that probably means people will be returning to offices. I think there's probably a whole host of things we could go into, but it probably involves a critical analysis of the carrying cost of the property versus potential future income. Look at what incentives you can provide to bring in new tenants, keep existing tenants, and defer or minimize those ongoing expenses. You know, we could probably do an hour just on that. Tough question, but I think if you do a critical analysis, there are probably some things you can come up with. Jackie, I don't know if your mic got muted. We can't hear you.
I think it got muted there. Sorry about that. We have another great question from the audience. How can the senior generation finance a sale to children or unrelated managers who don't have much cash to pay for the ownership? Rhett, would you like to take that one, or Joe?
Sure. So the question is, if our buyers do not have the means to actually purchase the company.
Yep.
So a lot of this is fairly common with intra-family sales. A lot of times the trusts that we create actually act as the buyer when people want to sell. I would say that you typically set this up so that your seller has a security interest in the company. And so the company serves as the security for the note, the promissory note that's payable back to the owner. And the ultimate recourse to the owner is if the cash flow from the company is not sufficient to support the payments back to the owner, that they can retake control.
Great. Thank you, Rhett.
I think I'd also add, there's a lot that can be done in terms of flexibility. You know, typically on the owner side, it's a question of, as Rhett said, security, but also cash flow. What do I really need if I'm going to finance it, if I'm not getting the purchase price all at once? Typically, the interest rate in those related transactions can be lower than if you were doing outside financing. We can get more creative with amortization schedules. So there's probably a number of things that can be done. And the other thing is, especially if it's intrafamily, if it's to a child, there's already some leverage or down payment there when you answer the question, should the child really have to pay for their own share? Or can they receive that portion of as a gift, so that really what they're doing is they're buying out the owner, but in effect buying their other siblings out of future ownership?
Yeah, and Jackie, this is why both of those were perfect answers, but this is why I always say you start with purpose and you start with happiness, right? The critical piece of that answer is, are you happy with a plan where you don't get where you don't get liquidity, right? That you don't get full purchase price on the sale. Are you happy with a plan where you take on the additional risk of the continued performance of the company? Are you happy with a plan that you're getting paid over time? So again, that's why you need to start with a very honest reflection of what you want in the transaction, and then figure out how to best accomplish that. And again, if it's part of how do we honor loyalty, being the bank for insiders is a way to honor loyalty. If it's how we honor legacy, making sure that your kids have the easiest way to get ownership and leadership in their hands is the way you honor legacy. But again, it goes back to what's the original purpose. Don't solve the problem first until you know what the purpose is.
Great. Thank you. We do have one more question that we'll address today. That question is, if stocks typically transfer only to blood-related family members and not spouses, how do you go about setting up an IDIT?
Well, so typically typically if there is a limitation that allows for the stock that restricts who can receive shares of the company, that restriction permits the transfer to family members or to trust for the benefit of family members. I'd say that's the most common thing we see. So there is normally a carve out that allows for the transfer of shares to the IDIT as opposed to outright to descendants of a shareholder. And if you're not able to do that because of the restrictions in the shareholder agreement or operating agreement, maybe you can look into having those provisions modified before you actually engage in the planning.
Great, thank you. That concludes our question and answer for today. Thank you for joining us today. We certainly hope that you found the information was helpful to you and to your organization. Both Johnson Financial Group and Husch Blackwell really appreciate your attendance today. As a reminder, this program has been approved for legal education hours. To report your hours, please click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow, along with a recording of the webcast for watching and sharing. Please be sure to complete our brief survey. We do use your feedback to plan future programs that are applicable to you and your business needs. Thank you again, and this concludes our webinar.